Well, thank you so much, Wei Min. It's really a pleasure to be here today and to be launching this important research here in Kuala Lumpur, where, as you mentioned several years ago, the idea for undertaking something that was really more comprehensive around the legal and regulatory environment for alternative finance was kind of conceived. This report, when I conclude my remarks, we'll show you how to get access to it, but it's already available online. Would direct you initially to the Cambridge Center for Alternative Finance website to see it, but it'll also be on the World Bank's Open Knowledge Repository. And it was made possible also through support of the Malaysian government, through their contributions to the World Bank Group's Global Knowledge and Research Hub in Malaysia, and with support of our partner in this research, the Cambridge Center for Alternative Finance. So here what we have is I wanted to start out, instead of jumping into the survey and the responses, just to take a minute or two to talk about our motivation. You know, why is the World Bank looking at these, kind of some of the edges of fintech and kind of this particular space? And you'll see that just as the regulators have a lot of optimism about the opportunities and the potential for alternative finance, so do we at the World Bank, because as Wei Min was mentioning earlier, we see a lot of need where this could be part of a solution as we go into the future. So in particular, work that's been done by colleagues of mine at the International Finance Corporation, the IFC, has shown, and for those of you taking pictures, the slide deck will also be available afterwards. So if you can also count on that. So research that we've done has indicated that there's an enormous gap in access to finance for SMEs around the world, micro, small, and medium-sized enterprises. And this actually, we believe, sums to more than $5 trillion. And by far, in terms of the different regions of the world, East Asia Pacific has the largest finance gap for micro, small, and medium enterprises. And also some of the largest, just total numbers of over 60 million. So worldwide, 160 million of these firms need finance, but even just in this region, it's more than 60 million. So a huge need there that's not been filled to date. But it's not only firms that need access to finance. As we can see, it's also individuals. And actually, we've been making some good progress globally with providing access to consumers for financial services. The World Bank has financial inclusion as one of our top development priorities. We have something called the Universal Financial Access 2020 corporate goal, where we're working to really close the gap for adults in access to formal financial services. By next year, we're working hard to continue to make progress. But we know, based on data from our Global Findex survey, which is a demand-side or consumer-based survey that's done in more than 140 countries every 3 years, that between 2011 and 2017, approximately 1.2 billion adults entered the financial system and got access to an account. So the red bars are the accounts. You can see, in a lot of regions of the world, this is, 40, 50. In Asia, about 70% of all adults, reporting to this survey say that they have a formal financial account. But it's much, much lower for having savings in formal institutions or borrowing through the formal system. So that means that a lot of people are doing this either through unregulated providers or they're doing it informally. So again, a huge opportunity, a huge need, and we have a lot of research that shows it's important from a development perspective, which is of course what motivates us at the World Bank, to have access to financial products and services. It has to do with economic growth, which is like through the enterprise channel, but it also has to do with increasing resilience, reducing poverty, and so it's we have twin goals of growth and poverty reduction. This is important to achieve both of those. So as Wei Min alluded to earlier, in this survey, we're looking basically at peer-to-peer lending, equity crowdfunding, and initial coin offerings. That's what we're calling alternative finance here. And we see that just as we have, motivations for being interested in this, the regulators that we surveyed, their motivations align with ours. So you'll see between 75 and 85% of the regulators surveyed said that the access to finance for small and medium-sized firms was one of their, was something that they had. They expected that alternative finance had significant potential to help them with that goal. Also, consumer access to finance, there it was a little closer to kind of 70% on average, also thought that alternative finance could be part of a solution for closing gaps in consumer finance. And then we had kind of a broader term of financial inclusion, which many also responded to. One thing, just going back for a minute, one thing also that you'll note is that these ideas were just as strong in lower income countries. And in fact, some of the most optimistic regulators in terms of what alternative finance might bring to them were in jurisdictions such as countries in sub-Saharan Africa, which have, a very significant financing gap. So, we see this not as something that's only for, a certain type of country or a certain income level, but it's really potentially, if done correctly, has applications around the world. Other questions that we asked about were, did they see this affecting, and improving potentially competition? And it's interesting to see that, again, about 2/3 thought that alternative finance could help them with competition. And interestingly, in Latin America and the Caribbean, where you have, more concentrated banking systems in many of the countries, this was something where they saw maybe an opportunity for some contestability, for some, increased competition coming in through new markets and new entrants, such as through alternative finance. Also, job creation was significant. And again, going to Africa, regulators there saw this as an opportunity to increase opportunity to finance for women. So now I'm going to move to the survey part. So now this is the motivation. This is why we think our motivations and our ideas coming from kind of the global perspective are aligning with what we saw in the regulators. So now what did we do to, and this basically follows along the lines of the report. So I hope also, afterwards, maybe some of you get into a little bit more detail through the report. But this is the map we did. We had really, I think, for a first survey, we had an incredible response rate. So we approached, in total, more than 200 jurisdictions, and 111 jurisdictions responded. Now, jurisdictions includes countries and some subnational where there might be instances where there's kind of different regulatory treatment. But this gives you a sense, really, really great coverage, very strong coverage, especially in Latin America. As Wayman mentioned, the International Organization of Securities Commissions, IOSCO, they were very involved in helping to circulate this survey amongst their members. Then we did follow up also through both the Cambridge Center for Alternative Finance and the World Bank. And these were done through an online portal. In a couple of cases, we had to put the information in ourselves where that was needed, between just April and June of 2019. So these are really very fresh data, very recent. And here it just gives you a little bit more, going from the map to the table. You can see we've got, good coverage across the world. There's some regions, in particular Middle East and North Africa, where we, would like to increase it even more in future iterations. But I think you can see that, quite good coverage across a global set. And I think this is also important, again, with the idea that this is not only a high-income country issue. We had about 40% of our respondents from high-income countries, but 60% from lower income. And that includes 33% from low and low-middle income. This is important because we wanted to understand, as we sent out initially, and the main group of regulators responding were securities commissioners. What were they responsible for? What were their statutory objectives? And so some of those things were consumer protection, market integrity, financial stability, and then growth of or development of financial markets. But we also think it's important to identify some of the non-statutory objectives that came out strongly. One of those was financial inclusion. So when you add 40% statutory, 51% non-statutory, that's nearly the whole sample, more than 90%, looking at, making sure there are new opportunities for people who may have been excluded previously. And also supporting competition. Again, 51%, just over half of the sample said that was an important non-statutory objective that they had. Okay, so now this is the first kind of set of slides I'm going to show is kind of a high-level view of what the survey results told us about the status of regulation for alternative finance globally. So here's, we excuse me, we created based on the research that and the responses that we got back, we were able to classify as whether or not these activities were regulated in particular jurisdictions. So that doesn't necessarily mean that there was a bespoke regulation. This included where regulators would say we're regulating under existing securities market regulations, for example, in the case of equity crowdfunding, or where they said, it's we've adapted existing regulations. So there were a variety of kind of situations that we've pulled under regulated. But as you can see, there's more likelihood of regulation and being in a regulated kind of framework in the higher income countries than in the lower income. Especially equity crowdfunding tends to be more likely to be regulated at this point than the peer-to-peer lending. The initial coin offerings, you can see, actually have gone very high. I think that was also just in the last, obviously, couple of years as that activity really took off and there was, concern in different regulatory environments about making sure that some kinds of rules were established. Here's the types I mentioned here that what was put into those buckets of being regulated. So you can see the peer-to-peer lending is at about 20% of jurisdictions that we surveyed, saying that they had some kind of peer-to-peer lending. The 5% at the bottom there is regulating under a pre-existing framework. The second, the 12%, the middle bar there, is that there's a bespoke regulation, and the last 5% regulated under an existing framework but with adjustments. So this gives you a sense that 12%, 22%, and then 4% are bespoke regulation for these different categories. In the ICO, we have this potentially regulated kind of other there because ICOs could be potentially considered securities, but if a jurisdiction had a situation where they said, okay, there could be things that are issued under kind of ICO that we would consider a security, we'll call that, an other kind of regulatory treatment. And so that's why we've got this kind of large segment. It's regulators saying, we foresee a situation where we may have something that's comes through the ICO channel that we would have to regulate or would be able to regulate under some of our existing laws and regulations. This is one of the findings that I think is really exciting and interesting. It's about just how quickly the regulatory framework for these activities is likely to change. So we asked regulators, do you think that in the next 2 years, so just 24 months, which for laws and regulations isn't a lot of time, especially for laws, do you expect that the way that you regulate this activity is going to change? And as you can see, for equity crowdfunding, half of the jurisdictions said yes. So that's a tidal wave, like a tsunami of regulatory change in this area. And that's maybe a bit daunting, but I think it represents an enormous opportunity. Because if, as you know, once a law is passed, usually it takes a while if you're going to make modifications, if you realize, you didn't get it quite right, usually that's not going to happen the next day, right? There's a period of time during which, it'll stay in force before there would be reforms or changes. And so, this is an opportunity for kind of and this is some of the benchmarking and other activities that we're going to talk about, for kind of the global community of regulators to try to make sure that these changes reflect best practice, reflect what we know about what's working so far. But even in marketplace lending, P2P, and in initial coin offerings, kind of around 2/3 said either we definitely expect a change or we may be changing. Only about 15%, as you'll see, said no, there's not going to be any change in our regulation. So essentially, you can kind of expect that in most markets, there's going to be some change. And we wanted to know, how do regulators think about, when they're starting to undertake these kinds of changes, what are they going to do in an area and a topic such as alternative finance, which is only a few years old, where there's not an established, code of best practice that's been discussed at the highest levels for years and years, and where you really have to learn by doing in at least part of the time because of also the rapid change in this industry. The triggers of changing laws many times came from them looking at other countries. So, looking at Malaysia, or looking at the UK, or looking at Mexico, or looking at peers and trying to understand what they were doing. Also from industry requests, and I thought it was quite interesting, the great panel right before me, where it was from Crittenden, John? Is it John? Jeff, from Acorn, mentioned how important a decision it was for their firm to have gone through a regulatory process. So, it's not surprising that we see that through the responses of the regulators, that industry is sometimes asking them for clarity. And then once a process for regulatory change happens, how does that, who are the regulators learning from? How are they, approaching this? You can see that very high figures for analyzing regulatory frameworks of other jurisdictions. So we certainly hope that the report that we're presenting here today is able to, facilitate some of that benchmarking activity that we know regulators are doing anyways with the detailed information that we're providing. Also, consulting with other bodies such as, firms, industry associations, other stakeholders, potentially on the consumer side. Very little on white papers and kind of the traditional, the analog version. So this, I think that the regulatory responses reflect the fast change and kind of a different approach maybe that some regulators are taking now to at least this sector. Something else quite interesting, the platform finance kind of knows no bounds on some level. It's not, it's not physical in the same kind of way necessarily. It doesn't have physical presence like bank networks traditionally have. And what we see is that when regulators are looking at, who do we get inspiration from, a lot of times it's not just the neighboring jurisdiction. It could be in another region completely. So there's a lot of cross-fertilization, not just country to country within regions, but people really looking at what's going on, outside of my kind of smaller scope. And as we mentioned, in the East Asia region, Singapore and Malaysia among the top jurisdictions in terms of where people are getting inspiration, where regulators are getting inspiration for how to move forward on their regulation. The top jurisdiction worldwide was the UK, followed by the US, and then Singapore. So one other item in the EU, Europe and Central Asia, that's one of the regions where we saw more intra-regional, or looking at peers in your same region, probably because of the EU itself and the fact that there's consistent regulatory treatment. So it makes more sense to be looking close by. So just a couple of, I've got many more experts in front of me than I am about Malaysia's experience with regulation, but I just wanted to highlight, some of what gave us, what we, benefited from so much by the partnership with the SC and working with Malaysia on this. Some of these findings on the industry are from the Cambridge Center for Alternative Finance's East Asia report. So between 2013 and 2017, the growth of alternative finance in Malaysia was approximately 125% a year. And of course, the starting points are small volumes, small values, so you have very fast growth at the beginning, but still quite impressive. So the number of firms, and I hope this is up to date, I think as of last spring, so I think it's a few months old, but more than 60 firms have raised money through crowdfunding, and the total volumes raised, the total amount, is larger than some much larger economies such as Japan and Indonesia. It's also really, I think, important to see that it has had a financial inclusion impact, because 70% of the beneficiaries of equity crowdfunding here have been either women-owned businesses or businesses owned by youth. And most P2P investors, the findings were that they're under 35 years old. So this is really a dynamic, young, inclusive situation. And I think this last bullet point at the bottom, there's very high satisfaction reported amongst the industry. 80% of the industry that were surveyed said they're satisfied, happy with the regulatory environment here for alternative finance, the highest of any country in East Asia. So what is that experience with alternative finance regulation? Was women mentioned in 2015, the regulations were put in place for equity crowdfunding, followed the year after in 2016 for peer-to-peer lending. It's a principles-based regulatory framework, and it's focused on micro, small, and medium-sized enterprises. So actually, consumers here are not able to raise funds on these platforms. That's different than in other jurisdictions where they're, especially peer-to-peer lending is something that's available to consumers. Data on peer-to-peer borrowers can be shared with credit reporting firms. I think this is an important issue. Sometimes, depending on the economy, there may be a well-developed credit bureau. If that data is either not available to the platforms or the platforms aren't sharing that data with that credit reporting system, it weakens the ability of that system to really function properly. And it takes away a source of potentially valuable data to the platforms, which would enable them to ramp up their activities even more quickly and just be more robust. A secondary market operation is allowed here. There are caps on the amount that can be invested per fundraiser and per investor. And something that I very much like to see, because we know based on all of our research at the World Bank Group that women and there continues to be a gender gap in access to finance across just a variety of aspects of the financial services industry. And sometimes this is not only in lower income countries, it can be true also in higher income countries. And one of the ways to really address this is to understand better where those gender gaps are occurring and where progress is being made. And so having a requirement to report sex disaggregated data so that there's awareness of who is on the platforms, who's benefiting, what's the behavior by gender is really important. And here's a bit more information about the experience in the Asia-Pacific region, again, looking at that regulatory breakdown. And in general, kind of some big takeaways. One is that Asia-Pacific is more likely to be regulating these activities than the global, than in the global sample. And it's more likely to be using, countries in Asia-Pacific are more likely to be using some kind of adapted framework from existing regulation, a little bit less likely to be using the bespoke. And what my assumption would be is that means that there's a lot of space still and probably opportunities and likely changes in the future towards more bespoke regimes, which seems to be the trend. Malaysia. The Malaysian flag is on the bar that represents where the regulation would be where the kind of regulation that's in effect here. Okay, so now the aim of regulation. We think this is really important. So overall, kind of the big takeaway is that what regulators are really seeking to do is to make alternative finance something that's fit for purpose for the regular, investor, the so to speak, person in the street who is interested in being involved in some kind of investment activity, and a sustainable source of finance, especially for micro, small, and medium-sized enterprises. So here I've put together the information for peer-to-peer lending and for equity crowdfunding. These are the permissible activities. And what you'll see is that, obviously promotions to individual investors, very important for P2P. It's kind of the whole point of that activity. Fundraising for incorporated entities, and then a couple lines down for individuals. These are the kinds of activities that are allowed under the regulatory framework. So each regulator was asked, which of these things is possible in your jurisdiction? And actually, a takeaway that I have, and these are the most frequently responded to, is that there's still a lot of diversity, because as you can see, okay, 100%, say, in peer-to-peer lending, you can promote to individual investors, which of course is the business model. But then you kind of quickly go to, below 60%, allowing some of these different things. So this is, again, where, opportunity to learn across jurisdictions and, potentially as things go into the future, have maybe more consistent treatment across jurisdictions would be important. Now, these are the selected regulatory obligations for peer-to-peer lending and for equity crowdfunding. And we've grouped them into a couple of different categories. So this is consumer protection and disclosure. You can see accurate communication, standardized disclosure, complaints handling, all have significant coverage for both types of activity. On a lower level, advertising restrictions, and this, the question asked in particular about social media, those were there about 20 to 30% of the time in terms of the whole sample. Then on due diligence and information sharing, credit checks on borrowers on P2P platforms. It's kind of interesting, I think, that those, there are more than 20% of the platforms where there isn't a credit check. So I think that it would be worthwhile to unpack that and understand a little bit more how are they verifying or getting information, really, if they're, kind of, when they say they don't require a credit check. Eligibility criteria having to be met, verifying the claims of the fundraisers, and then again, sharing the data. As we see here, and one thing that we've worked on a lot at the World Bank Group is credit reporting and sharing of credit information, because it adds to, reduces information asymmetries, increases incentives for borrowers to repay, increases transparency in financial markets. And I think it's kind of, it's an opportunity, at the very least, a missed opportunity that this kind of data sharing hasn't yet become part of the peer-to-peer landscape. But I think there are some challenges there, because banks sometimes own and dominate the credit bureaus or the credit reporting systems in some countries. And if these are non-banks, they wouldn't want to give away, their valuable data in a system where they maybe don't feel like they have an equal seat at the table. But there's opportunity there to make sure that this new channel doesn't kind of reduce transparency or lock people in, because the only entity that has the information that they're a good payment risk is a specific platform. AML and corporate governance were issues that are often part, obviously, of the regulatory obligations. Wind down plans a little bit less frequently. And only a small percent had the requirement, rather, that you have to hold capital proportionate to the investments. So kind of showing part of this spectrum of responses to regulation in this area. Now, in all of those previous ones, you saw that there was essentially a lot of similarity between peer-to-peer lending and equity crowdfunding. Investor protections were the area where you do see a difference. Where, for example, equity crowdfunding here at the bottom, promoting to investors differently based on income or wealth, something that's more frequent, capping the amount that can be invested. And I think this just goes actually to the kind of some of the core difference here, which is that in the crowdfunding space, you're making an equity decision. There's a level of risk that's implied with that's different with the peer-to-peer lending model used by many platforms. For ICOs, there weren't. This is kind of a less heavily regulated, I guess one might say it in that way. I mean, there's a lot of expectation that the buyer beware, that it's up to the investor to be making the decision, that's kind of part of the aspect of this activity. So, not a lot of consistency across jurisdictions in what was required and what were the permissible activities, rather. And in terms of selected regulatory obligations, they really are around, making that, ideally hoping that you are equipping your investor with the information, with disclosure, with some of this basic management, such as separating client and firm assets, so that if they enter into these kinds of opportunities, they will be protected in that way. And I think it's important to note, again, promoting to investors differently based on income. So recognizing that these platforms may be able to reach new kinds of consumers, but that means they may be reaching people who may be less familiar with the risks that they're really taking on, and so trying to mitigate that by having some caps on how much any particular individual could invest. Okay, so that's kind of some of the detailed information across in terms of the rules and regulations. Now we're going to look at the supervision, because what we see happen sometimes in terms of laws and regulations, in general and in finance, which is where I've spent my career working, is that you could have a great law or regulation, but if you don't have the supervisory powers or resources to really follow it up, it ends up being a bit of a paper tiger, right? And so you really want to understand not only what are the laws and regulations, but then how are the supervisors working to put those into place and to enforce them. So first I wanted to show you here what the regulators said to us about these are their top concerns for the alternative finance industry. So it has to do with fraud, and it has to do with capital losses for investors, and misuse for criminal purposes such as money laundering. And here what we've done, and the next two slides will show you why this is more interesting here. They're reasonably aligned. So some of the regulators that we had responses from had direct remit for regulating a particular activity, right? And they might have remit for equity crowdfunding, but not have remit for peer-to-peer lending, for example. And so what you see here is the dark green is when a regulator has the remit and responding. So they should be more familiar with the activity. And the gray is where the regulator is giving their opinion, but they don't have direct remit for regulating that particular activity. So here's where regulators with remit perceive greater risks in general, and that's investor exposure to poor products. So the regulators that are really looking at what's going on day to day with this, that's one of their concerns. And inability to liquidate or realize investments is another area where the regulators who have remit are particularly concerned, more so than those who do not have remit. The ones that don't have remit are more concerned about issues of over-indebtedness. So it'd be interesting, we haven't had the chance to really do more of the kind of deep analysis of some of these really interesting data. It'd be interesting to see what's behind that. Why is it perceived to be more risky, on over-indebtedness before you're actually in the process of regulating this industry than after? Similarly, misuse of customer data. There's certainly, this is a data and technology-driven industry, certainly something to be concerned of. It's interesting that seems to be more of a maybe concern beforehand, so not sure exactly why. And then just in the case in particular of ICOs, regulatory arbitrage was seen as more of a problem. I think it's kind of interesting actually that in general, regulatory arbitrage isn't seen as a particularly large problem by any of the regulators, given the fact that there is, often there are multiple remits or multiple regulators who may have some kind of remit over this activity. Here we asked about changes in staffing, and as you can see, in particular, there's this is between 2017 and 2019. In equity crowdfunding, regulators responded that they were really staffing up. So we think that's quite an interesting, piece of information, just how strongly the industry is trying to respond to the needs of regulation in this space. And we asked regulators, what are the impediments to you being an effective supervisor? And by far, as you can see, limited technical experience within the regulator was what they responded. So this is, really cutting-edge activity a lot of times. It's not something that regulators would have seen if a regulator had been in commercial or, kind of banking or regular investment activity and then gone to the regulator. They wouldn't have been in this industry. There are probably not a lot of people the age of our previous panelists that have, already made kind of a shift from industry to regulation. So it is a real, it's a real need. Okay, so how do regulators make that, bridge that gap? So the next part of our survey looked at regulatory innovation. So what we see is that it's uncommon, but it's growing, and especially there are some pockets of greater activity in Latin America and in Africa in particular. So the three kinds of innovation that we were looking at, or technology-enabled activities, was one, an innovation office, and by this what we meant was, is there a focal point in the regulator for firms, startups to come to and say, I'm thinking of doing this, would this be legal? Or how would I approach a particular situation? So some kind of light touch, which isn't, presenting a whole, kind of complete story to the regulator, but getting advice in a more informal way. And those have various, characteristics, but that's the idea. Then regulatory sandbox, that's a really more kind of detail or more structured kind of approach where firms can come in and in a small, usually within a small number of customers, try out something with the regulator, kind of being very present in seeing what's going on. And then RegTech, SupTech is technology applications to facilitate either compliance by firms or supervision by the regulator. And what you can see is that there's currently about a quarter have either an innovation office or a regulatory sandbox, but under consideration, RegTech and SupTech are amongst the most highly sought after because regulators are seeing that they just can't deal with the quantity of data and information if they don't bring some technology to bear. And it's interesting that the innovation office, which is kind of a lighter touch, I mean, it could literally be kind of a phone and a desk and a knowledgeable staff member of the regulator, is more common in high income jurisdictions, whereas the more kind of resource-intensive activity of developing a sandbox is actually more common, although not in absolute terms, but in medium and low-income jurisdictions, and in places such as, for example, sub-Saharan Africa. And this is we asked how many firms have you helped through these different activities, and as you can see, it's kind of more than a 10 time, I think it's 12 times the difference between the regulatory sandbox, which again is a much more intensive kind of partnership between a firm and a regulator than in the case of the innovation office. So I'm going to just jump to this one and then go back. This is how these different innovations have helped with understanding key technologies. The innovation office, 92% said it had helped them. There was actually a lower percent with the sandbox. So these were kind of, to be honest, somewhat surprising results to us. We just think that this is a word of caution, especially for regulators who may be really resource constrained. That they should be, thinking about maybe some of these lighter touch approaches, at least initially, such as the innovation office. And then in terms of RegTech, SupTech, machine learning and blockchain were amongst the most widely used technologies. Okay, so this is just the final couple of slides. So there's going to be a lot of regulation coming up, as we've seen, lots of change, so that they can take advantage of these opportunities. And this is what I showed earlier, what percent of these jurisdictions expect change. And this is the regulators, where are they getting help? Where are they getting this benchmarking? Where are they getting the support? So the orange is where they've received support in the past, and then where they would like to seek it. And as you can see, they're interested in support across the board by organizations such as the World Bank, international groups, by academic. There's the final one, I'm sorry, which says 61%. There's an error. It should say academic institutions, and then associations of regulators. And what's kind of interesting here is that the donors and the financial part is not what they're interested in as much as the technical support and the technical information. So with that, I know we started a little bit late. We're a little bit, I guess, behind schedule, but the information is on the Cambridge Center for Alternative Finance's website, on our open knowledge repository, And we certainly look forward to continuing this research and our partnership with the Securities Commission and the Malaysian government. So thank you very much.
Thank you, Margaret, for the presentation. We will now open to the floor to answer some questions. Is there anybody who would like to ask some questions to the World Bank team who has conducted this survey that is actually that's actually received the most responses of a survey of its kind?
Thank you very much for your excellent presentation. On the ICOs, I have 2 questions. One is, how do you define what are ICOs? And in the countries that I think you seem to say they are regulated, which countries are they regulated, and are they regulated as securities?
So we were looking at tokens that could be regulated as securities. So we kind of restricted the definition a bit because it can be so broad. I could get into, if you'd like, maybe after the presentation, we could look kind of a little bit more in depth at which jurisdictions said that they were regulating. But as you saw in that one of the slides, in many instances, regulators responded that they could be regulated if they existed. So they hadn't yet had an ICO that had been issued, but they were foreseeing that there were types of ICOs that could be considered securities where they would then be covered under some existing legal or regulatory framework.
Thank you for your presentation. I just wanted to ask in terms of, there was a graph about Asia Pacific and Malaysia with the Malaysian flag tacked onto it.
Yeah.
I didn't quite get that bit. So does that mean that Malaysia is following the trend regionally, or does that mean that that is specific to Malaysia only, those results that you highlighted?
No, so this is based on, I believe it's 14 countries in Asia Pacific. So that's the percentages that you see is based on this grouping of about roughly 15 countries, and the Malaysian flag is in the segment of that where the Malaysian regulation sits. So like for peer-to-peer lending, that's regulated under an existing framework with adjustments and exemptions for this specific activity. So that was how that's meant to be interpreted. And as I mentioned, in Asia in general, the level of regulation is higher than the global average.
There's a question in the crowd there.
Hi, I'd just like to know in terms of the fundraising exercise, whether the other regulations.
Oh, there you go. Sorry.
The other regulators, whether they restrict in terms of the ability to fundraise, whether it's just for SMEs, MSMEs, or can it also be for the retail market?
So you're saying for equity crowdfunding or for?
Yeah, the fundraising activities, whether there's any restrictions in terms of the scope of fundraising that can be done on the platform.
So we did ask, for example, figure out which way to go, whether they could, I think it's this way. So the permissible activities, let's see. Oh, okay. Let's see, I need to go back this way. Well, I think they put it back to the other. Anyways, what we saw there is that there are some platforms where you can reach out to both individuals and to firms, but like is true in the case of Malaysia, fundraising on platforms here is limited to businesses, to enterprises. So in that sense, the rules differ varying by jurisdiction. I don't know if that's answering your question.
Where jurisdictions where they allow for the retail to access the platform, what's the purpose for it? Do you know?
You mean, why would you not want an individual investor to be able to raise money, or,
Not the
or an individual fundraiser?
investors. Yeah, the fund persons accessing the platforms. What sort of fundraising activities are they looking at in terms of for the individuals, for example?
You mean where an individual would be raising funds on a platform? I mean, I think these are, decisions around risk management that different jurisdictions take into account, based on their understanding of the local market and maybe their risk appetite as they start to allow these types of activities to happen. It's always a balancing act because you want to, there's a real opportunity here, which we see for financial inclusion and for inclusiveness. And so at the same time, there are risks and they need to be, addressed. So I think that probably in some instances, these could be evolutions where, you see how things are working, where the regulator, observes what's happening under a particular regime, and then sometimes, different activities are maybe allowed, in the future. But there's obviously a large scope of different kinds of regulatory environments, different kinds of regulatory capacity. And so, we certainly don't think one size fits all, but we do think that there's a huge opportunity for learning across jurisdictions and starting to understand what are some emerging good practices. And that's a space where we're very keen to work with, the Securities Commission of Malaysia and other leaders in this field to really develop a more clear understanding of what would be, kind of some of those core good principles.